very warm welcome to all our participants to an exciting session on alternate financing solutions for startups, brought to you by KTech Center of Excellence, Data Science and AI in collaboration with 10,000 Startups and Record Club. My name is Supriya Samuel and I'll be your host for the day. It's a pleasure to have Eklavya Gupta, CEO of Record House, who will provide his valuable insights on three key areas on the topic we just spoke about. Number one is how to strategically raise capital, increase your valuation, and the need for alternate sources of financing. Quick introduction to Eklavya for those who haven't met him before. So Eklavya Gupta is the founder and co-CEO of Record Club. He's an investor turned entrepreneur with a passion of democratizing financing for recurring revenue companies with 10 plus years of enriching experience in capital markets, structure credit, and private equity. Without any further ado, I would now like to invite Eklavya to take the stage. And just a minute, like there are a few ground rules which I would like to mention. Please feel free to put your questions in the chat window here. So we will be having 40 minutes of session and the last 20 minutes will be parked aside for the Q&A. Also, I'll be dropping the survey link here on the window, chat window, which you can fill to provide your feedback on today's session. So the stage is all yours. Eklavya, over to you.
Thanks, Supriya, and hi, hello all. Excited to be here, right? And obviously we are all learning as we proceed. I think times are tough, capital markets are tough, equity raising is tough currently as we speak. So we thought it will be a good time to discuss what all options does a founder today has, and what are there are multiple options. Let me start with saying that founders today are lucky to have plethora of options, unlike 5 years back. So it's a good thing for all of us. And I'll talk to you more about that as we proceed so that, it can give you good clarity in terms of what all can you actually, do as a founder. And while I know Supriya mentioned that we can keep the Q&A for end, feel free, to barge in with anything in particular that you want to harper upon. The more interactive it is, the more better. So I think it's always good. Idea is for you to go out of here, with ample clarity of how you should build your, financing and what works best for what kind of solutions. So I'll delve deep, right? And thanks Supriya and NASSCOM 10,000 Startups, right? For giving us this opportunity and KTech Center of Excellence. I think we are in for very interesting times in India. We see around 10,000 plus startups opening up every year in India, right? That's phenomenal. Anywhere globally do we see that kind of a pace. So I think India is doing a great job in terms of building the ecosystem, in terms of enabling and promoting the ecosystem, both from a private and public point of view. So I think it's the best time India could have ever seen in terms of innovation that's happening. We've seen multiple plethora of startups coming up. Last year saw 50 plus unicorns. Crazy, right? Third largest country with unicorns. And even if you're not a unicorn, right? You disrupt something, you innovate, and I think you feel really privileged and really, enriching in terms of your experience. So I'll talk to you today, about A, where the current market is, B, what are the different financing options, that a founder today has, and C, when to use what kind of options, and D, getting into a little detail of what does it really mean in terms of actual cost of capital, right? Because if you take any financing, cost of capital, what you get versus what you give, right? Keep that at the back of your mind, because you don't get anything for free, right? I think, let me be very clear. Any kind of capital that you get comes with its own pros and cons. So one needs to be totally aware. So I'll delve deep, right? Just starting up, I think, what are the traditional ways, right? In which companies were financing themselves, right? Typically, Supriya, if you could want to the next slide, if you don't mind, or I can share my screen if that's easier. Sorry for that. Yeah, cool. Thanks. So traditional way for founders, to raise capital, equity, we know, right? That's, you want to raise capital, it's associated with, you do equity, because that's been the only form in which companies can raise capital. What does it do to you, right? It gives you good capital to start your business, right? That's great. It doesn't have any obligation for you to pay back, right? So you take money, in return, you give a percentage stake of your company, right? That is equity VC. I'm sure a lot of people here know that in different forms and shape. It reduces your ownership for sure, but it gives you capital to kickstart your business, right? But I think it's extremely difficult to get equity capital. VC investors look for multiple things, right? Primarily being, the team that is building, especially in the early stages, right? Their background, their experiences, their skill set. I think the market they're addressing is very important, right? So that becomes very important. How large is the market? How complicated is the market? And C, I think, if you have started your business, then what is your traction? So it's typically defined by 3 T's, which is, team, TAM, which is the total addressable market size, and traction. So I think please keep sight of all those 3, even for yourself, right? Like while building a business, you are a shareholder. You want all of them to be aligned, to grow your business. Equity is great when you're starting your business, when you don't have, any kind of revenue running in, when people trust. It's basically trust-based, belief-based, on founders and on market where people invest, but they do take a percentage of shareholding from you, which, while the positives I talk about, the negatives were, it takes away your ownership and there is loss of control, right? Like you start something by wanting to have a lot of control on decision making. I think a lot of people, a lot of founders start their companies for that reason. But given that the control you lose over a period of time, there will be board of directors, there will be, a board with investors who takes a decision cumulatively. So be wary of the fact that how much do you want to dilute? I think that's very, very important. It always looks lucrative to get money, but it's very important to keep that side. So that is equity or venture capitalists of the VC world that we talk about. Traditional debt and loan accessible to a very few number of companies, right? You don't have to dilute, which is great, but you need a running business. You need revenues going in, right? But what you give for that is, you have a fixed obligation to pay back, as well as you need to either give any security in terms of share pledge, in terms of guarantees, in terms of collaterals. Bank, if you go to a bank for a loan, here bank would say, okay, but you keep this property of yours or this office building of yours as collateral to me. Most of the founders don't have that, right? Like what they have is their business plan, their startup, their idea. They don't have all these things, but banks don't understand that, right? And unfortunately, this has been limited to very, very few niche players of the society, a typical bank loan. Or even if they do, they will say, you guarantee or put collaterals or give a personal guarantee, which is not what a founder would ideally want, right? You don't want your personal assets or your personal obligations to be on hook just because you are starting something innovative and new. So that's been relatively on the lower side, but these are the pros and cons in the traditional way. Let's look at what happens if you take too much of equity, right? We have seen time and again, right? Like equity is great, but it leads to high dilution over a period of time, right? Typically, there is no typical, but on average, we have seen companies diluting between 20 to 25% of their equity, especially in the early stages in every round. And what happens, right? As a result, founders are typically, cumulatively around 10 to 15% of shareholding, when they go public in 5-6 years. And there are 2 or 3 founders, right? You're talking about, less than 5% shareholding. Yeah, we have seen that in cases of Zomato, right? Like great company doing very well, $10 billion plus IPO. Founder held only 5%, right? Think about it. Policybazaar, similarly, right? Again, went public last year, a great company. We all know it's such great, but founder holds 4% of the company, right? And maximum dilution happens in the early stages, right? Similarly, delivery, pharmacy that you see here. So one needs to be very, very cognizant, of what you are giving away. This is your heart. This is your bread and butter that you are giving away in terms of your ownership, right? While taking money. So we need to be very pragmatic as founders, that equity is the most precious form of capital that you have. It is most easily available, especially to fast growing companies. So it looks lucrative, but is this the best option? This was the only option, right? Like, and hence it became the best option. But I think I'll talk to you about what are the different options that are available today with founders. But keep in mind, right, like guys, you don't want that you're a unicorn 3 years, 4 years down the line and you hold 2% of the company, right? Might as well do a $50 million company, own 100% of it, right? Like it's the same thing. Why to go through that brat and rush? So think hard of where you want your business to go and what kind of shareholding that you envisage, right? Like to create wealth for yourselves as well. One is equity dilution, right? Like, but I think very, very important is the time it takes to raise equity. I am sure you guys must have experienced, some of you must have experienced at least, right? Easily it takes between 9 to 12 months, if not more, right? You start your conversations with some investors, right? Before that, you need to prepare your pitch decks. It will take a month or two. You reach out to multiple investors. And if you are raising equity, just as an advice, reach out to as many investors as you can, but to the ones, that basically fit into your bucket, right? Like who want to invest in your strategy, who are more suitable for your kind of businesses. So just keep that in mind. Then the next stage that comes along, you have to pitch to them, you have to explain them, you have to do endless number of talks, right? Like irrespective of how good or bad you as a company is, right? Because investors don't know what you're trying to build, right? So you have to convince them of what you're building. Could be easy, difficult, but it takes time. So it will easily take 5 to 6 months before you get any conclusive term sheet. And that too only 1 or 2% of the founders get there, right? Not everyone does. And most of the businesses today, like more than 90% of the startups die because of availability of capital at the right point in time, right? You say you have done 6 months without raising any, getting any concrete commitments. And even after that, there will be term sheets, negotiations, there will be due diligence, financial, legal that will be done. Then there will be legal documentation that will be done. So it takes at least a 12-month period, right? It's crazy, right? Like, as a growing business, in 12 months, your business dynamics completely change, right? So it takes a lot of time, and it takes away your focus, right? From focusing on doing and operating your business to actually going to fundraise. It's a full-time job to that extent, right? So be very confident of when and why do you want to raise equity, right? Otherwise, it's easy to lose focus, especially in the early to growth stages, right? That is very, very important. Debt, again, right? Like available to less number of companies, but you go to a bank, NBFC, even if they are willing to fund, right? Like I spoke about, very few people get access to that, but even if they are willing to fund you, right, they will, take a lot of time. I don't know if you guys have experience, would love to hear your thoughts sometime in Q&As. There's a lot of KYC documentation that they will go physically verify things. They will not, be able to trust and believe what's happening. And a lot of companies burn money, right? Since a lot of companies burn money, it becomes very, very difficult for a bank to finance them, right? Well, there's an old saying, right? Like, I don't know how many of you know it, right? Like, at least I've heard from my father a lot of times. He was a businessman, right? Ki bank ke chakkar lagane pad rahe, right? Like in Hindi, right? Like, and people used to do that day in, day out. Why? You don't need to do that, right? Your business is tech enabled. Your business is tech focused. You need a lot of things. Don't even think about it, I would say. Is there an alternate? There are a lot of alternates that are reaching up currently. And I'll talk to you about, some of those options as we proceed here. So don't get intimidated. I think these are 4 options typically available to the founders today. So you see, try to map these 4 options with multiple, parameters that a founder should evaluate their financing on. Red there indicates, this is a little on the negative side from a founder's perspective, and green there, indicates that it's a win-win for founders. So equity, we spoke about. So the 4 parameters I'll talk about, all these 4 financing options is availability, time to cash in bank, funding amount, and cost. For availability, if we start with equity, right, like limited, right, like less than even like 1 or 2% of the companies, typically get equity financing at any stage, right? Time to cash in bank, minimum 3 to 6 months. If you are a great company, on average, it takes between 9 to 12 months, right? Funding amount, it's your dilution, right? Like you dilute 20%, it depends on what kind of valuations you get, but it varies significantly, but it can be a large quantum as well, right? Like that's the benefit of equity, because once you raise a large amount, it gives you wings to fly, right? And grow your business. On the cost side, it's expensive, right? Like equity is the most expensive form of capital, all of us are aware, because you're giving away your growth, your ownership, your percentage stake. And if you grow even, 100% in 2 years, your cost of capital is 50% annually, right? Effectively. On venture debt, right? So typical bank loan wasn't available, as we were talking, then came venture debt few years back in India, which complements equity capital, which comes along with equity capital, but it comes only if you get equity. And imagine only 1 to 2% of people get equity. Of that, only a fraction of people get venture debt, right? It's even a lower fraction. So very, very limited, right? It also takes time. It's an offline play. It will take at least a 2-3 month period to get you money. The cost of capital, and maybe I'll take you through an example if we get time, right? Like the cost of capital is phenomenally high if you include cost of warrants. So how does a venture debt work, right? Venture debt typically has 2 components. One is a fixed return that an investor would expect. Say, an investor would say, I will give you $100. In return, I will take 16% rate of interest plus 15% equivalent warrants. What does that mean? That 15% of 100 that they invested. So that is $15. So $15 worth of equity is what you will give to them for free, right? Which grows, right? And if you include your growth and how much that $15 will grow to, right? It could, if you even double in 1 year, that 15 grows to 30. Effectively, you got $100 and you have paid them back 16% on 100, which is 16 rupees plus the 30 rupees, right? So 46 rupees. So your effective returns that you're talking about is 46% in this example, right? It looks that's a 16% loan or a 16% debt, but if you include cost of warrants, it is astronomically high. So, and this a lot of founders miss and ignore, right? In terms of when they're talking about taking venture debt. So please be very careful of the terms that you get, right? In there in terms of warrants or right to invest that those investors have to offer. Revenue-based financing, is a new concept that has started. I don't know if some of you have experienced or not. It gives you money for certain expenditures, for your marketing expenditures typically. And in return, it takes a percentage of your top line back, right? Like, so if your revenue per month is $10, right? It will say that I will take 15% off every month's revenue to repay them back. It's great, right? Sounds interesting, new concept, pretty good. But imagine if you're a fast growing company, right? And these are also a lot of tech platforms that are doing it. So, it takes very less time to complete these things, which is great. But you need to have solid revenue, to be eligible for these kinds of financing. But what happens, right? Today you are at $10 revenue, all right? You pay 15% of that. So $1.5 you pay a particular person back every month, example, right? What if tomorrow, and you're a fast growing company, especially in early stages, you start doing $20 a month? You pay that company 15% or $20 in that case. So hence you're paying $3 instead of $1.5 every month back. So you end up paying your capital back pretty fast or pretty early, which is effectively penalizing you for you growing fast. Not good, right? You will say as a company, hey, I'm growing very well, I'm doing very well, but I will pay you more because I'm growing well. Doesn't make sense, right? Effectively. So I think that's the pitfall. So if you as a company feel your revenues are going to be very volatile, very fluctuating, you could do $10 one day, $3 another day, $25 the next month, etc., then maybe think about it as an option, right? Otherwise, it will be a very, very expensive. If you think $10 around, you can do 8, 9, 10, 11, 12 ballpark there, or 10, 12, 14, 16 if you're a growing company, this can be an expensive option. So be very, very careful. And a lot of people, just between all of us, right, like market it very differently. So please be aware, what does that 7%, 8%, 12% mean? What is it that you are giving, right? Like it's 10% flat cost is what a lot of people talk about. So if you get 100, you have to pay 110, but in what time? No one talks about that, right? So if you pay 110 back in one day versus 110 back in 1 year, it is very, very different, right? Time value of money. So be conscious of that fact. It's a good option if you think your business is volatile, but it's primarily suited for e-commerce businesses, for tech businesses, for tech services, SaaS businesses. It's not a great option for any kind of recurring revenue businesses. And I think the fourth option is recurring revenue financing. In terms of it being post revenue, it's similar, to a revenue based financing company, though it requires a little more predictability in revenues. It's a tech platform. Typically, things move very fast. They integrate with your invoicing softwares, financial softwares, banking data, and run their models immediately. So within a couple of days, you can get terms of trade from these platforms. The financing amount could be very high. It could be up to 50% of your annual recurring revenue. So if you do $100 a month, that means $1,200 on an annualized basis. You can get up to $600 of financing through these platforms, right? Which is great. I think no other platform offers this service. And typically they charge, because they are financing your annual customers, right? You're giving you money upfront. It basically works like some of your customers pay you upfront today, right? Which is again great. And the discount varies from company to company, but typically we have seen this upfront discount being between 8 to 12%. So if you are financing $600 in that case, and it's a 10% discount, so you exactly know that you pay $540, and the $600 that you're supposed to get in the next 12 months is passed back to the investors. What it does to use alternate financing, we saw in the previous chart, couple of slides back, right? You were in, for your percentage shareholding was around 13%, right? If you keep on diluting through equity. If you use certain alternative financing solutions, right? Like could be others that I mentioned about in the previous slide, you could save easily around 10% stake, right? Over a period of 5-6 rounds. And if you become a unicorn, like $1 billion valuation, and you save 10% of your shareholding, founders can save over $100 million of their personal net worth, right? Think about it. Company has become a unicorn, companies in the same state, you generate wealth for yourself, right? So just be very pragmatic, very practical. No investor will, guide you properly for such kind of things, but you have to be very, very cognizant, right, guys? Because it is your equity, your hard-earned sweat and money that you're putting in, that you're giving away, just for growth. So be very mindful of that fact. Typically, alternative financing solutions, and we at Recur Club are a recurring revenue financing play as well. So I can talk about ourselves, not everyone. It's very fast, right? Like we get you capital within a couple of days. We integrate with your financing stack, invoicing stack, banking data, and it is extremely, extremely fast, because we want to support founders, right? Like for their growth, while we enable them and provide an infrastructure to get non-dilutive growth capital in a fast manner. But we want to be very, very pragmatic about, founders should focus on their business, and we can provide them the best possible growth channels as in terms of capital and other things that Recur Club can provide. So it saves you two most important things that a founder has today, right? A, equity, B, time, right? And then you can focus on your business. So we spoke about multiple financing options, right? Equity, venture debt, revenue-based financing, recurring revenue financing, and the different pros and cons, right? And happy to answer any questions later or on the sidelines on them, right? I know it's not a straightforward topic, but every founder should know it properly, right? Like that's our endeavor. So when to use equity, right? Like we said, one way we said equity is great, but other way we are saying, oh, but you lose a lot of shareholding. So what do we do? When do I raise equity? When do I use alternative financing, right? So I think we have divided a stage of the company into two broad parts. One is installation period, when you are setting up, when you're pre-product market fit, when you don't know what your business is going to be, when you don't have any revenues based on which people will finance you, right? I think equity is the best form of capital. Take equity, angels, friends and families, incubators, accelerators, VCs, all of them combined, right? It is more speculative capital, because the activity that you'll put it in is more speculative in nature. You don't know what the outcome or the payback is going to be, like R&D activities, like launching a new product, etc. Right? So equity is great, and I think equity is the best option one should have there. But once you start generating some revenues, right? 5 lakhs, 10 lakhs a month kind of revenues roughly, right? that is the time when other options start opening up for you, right? Like, so that we called as deployment period. You have set up your business, you have hired a team, you hired the management. Now you want to grow this business, right? So for that, and that you put money in so and so channels, and you generate, Y dollar returns from that channel. So if that is very predictable, if the payback period is very less, like certain activities like sales and marketing, customer success, you spend $10 in your CAC, which is customer acquisition cost, you generate $30 as your customer lifetime value. You know those parameters. If you know such things, why would you use equity, right? It's foolhardy if you would do that. So that's more like a production capital that you need, where alternative financing comes in and perfectly complements, equity capital. So what are the major criteria that one could have, right, effectively to see, your eligibility for, certain options like a recurring revenue financing product that you're talking about? You should have a recurring revenue financing from existing customers. Your annual recurring revenue should be around 75 lakhs INR, which is basically roughly around 6 to 7 lakh rupees a month is what you should be generating from your customers, because that is how you have to think from an investor point of view also, right? I told you at the beginning, nothing comes for free, right? So just be very, very careful. What all are you giving for the money that you get, right? And don't fall into optics, so very, very important, again, to keep it back of the mind. Runway, right? If you burn cash, typically, since these are cash flow based financing options, right? Like based on your cash flows and predictable revenues, you need to have a runway or liquidity for at least 6 months for investors to be comfortable and grow. I'll take a couple of examples, right? Like of how to use them, when to use such options, which complements multiple growth. So there was a bootstrapped HR, and these examples are from companies that we have financed at Record Club, so I can talk a little more about them in detail. It was a bootstrapped HR tech SaaS company based out of Chennai, right? It had a 75K ARR, right? It grew to around 352K ARR with using a capital. They took our capital 3 times. They spend that money in customer acquisition cost, in marketing, in hiring, in software implementation, right? Effectively, grew their revenue, grew their business. And, in 6 months time, it grew 4.7x, right? It's a great jump from a 75K ARR to a 352K ARR for the business. And they did not have to dilute anything, right? Imagine if you can grow your business to such levels. I don't know at what stage all the founders here are at. It is a great thing to have as an asset, right? And now they went on, last 2 months back, they went on to do an equity round as well at 500K ARR numbers. Think of the valuation jump they got just by using capital with alternative financing solutions, like a 6x jump in valuations, right? In the last 8 months, 6 months. Phenomenal, I would say, right? So there was another, growth stage VC marketing tech company. And best part about alternative financing platforms as compared to venture, it is having equity is not a mandatory thing, right? It's a good to have, it's not a must have. They value your businesses, they value your cash flows, they value your predictable revenues. They don't value your equity investors, right? Which venture debt firms do. So growth stage marketing tech company, they were initially planning to dilute 15% for 800K US. They started at Record Club. They had around $150,000 limit, which grew actually to 400,000, right? Effectively, as they grew, and they were able to grow their revenue, 2x in, again, almost 6 to 7 months. And then they did another equity round where they diluted only 10% instead of 15. So they ended up saving 5% or even more because they got an offer for 1.1 million. So we are talking about 20% higher capital roughly, plus 5% less dilution, right? So that's a major win, right? Like effectively you are saving your company, if you think about it, almost 7-8% of equity dilution here as the business grows. This is an example, I just put in there. Maybe I can take it later. If you have questions, we can take, or maybe I can quickly go over it. It will take 5 minutes if that's okay. So Example is, there is a company that has a quarterly revenue, Q1 revenue on top that you see, is $100. Q2 is, it's a growing company, 110. Quarter 3, they do 125, and quarter 4, they do 140. Assume their valuation multiples are 10x of their annual revenue. So their equity value correspondingly has been shown, as 4,000, 4,400, 5,000, 5,600. Now, what we have done is you have mapped, all the 4 options that we spoke about, what is it that you will get and what is it that you will have to give if you were to take $50 of financing in all these 4 platforms, right? So if you were to do, a revenue-based financing product effectively, right? So you give $50 and this assumes, you get 15% of your revenue back for your repayments. So you get 50, you have to pay back 55 by paying 15% of your quarterly revenue. So on day 0, you get 50 rupees. Then every quarter, you see on the first quarter, you pay back $15. On the second quarter, you pay back $16.5. On the third quarter, you pay back $18.8. And in the fourth, you pay back the balance effectively, right? So you pay back the 55, but it's very front-ended, right? And it is increasing as you are growing your business, right? As your business is growing on the top line, your revenue is growing from $100 revenue to 110, 125, this payment is also increasing. So these are fast track repayments for your growth, right? Which is actually penalizing you for growth, right? Let's take a similar example. You get $50 from a recurring revenue financing product. You finance $55 worth of cash flows today. So you give 50, you get 55. Similar, right? Sounds similar. But even if your revenue is growing, in this case, you exactly know, because you have financed your customers 12 months revenue, you exactly know how much do you have to pay. It's not that if you grew your revenue from 100 to 110, you will pay higher. In this case, you will pay, $13.8 every quarter back effectively. So it's back-ended, so your cost of capital is much lower. In both cases, you pay actually 10%, right? You will think that in revenue-based financing, you pay 10%. In a recurring revenue financing, you pay 10%. So 55 and 50, the difference of $5 on 50. But, you pay it over 12 months versus you pay it upfront, right? Like time value of money. What if you were to finance this $50 from equity? You're basically talking about a 1.25% equity dilution. So by taking this money through alternate platforms, you save 1.25% dilution. If this number was 100, this is 2.5%. If this number was 200, we're talking about 5% equity. So it depends on your growth needs. Just for this example, we have taken $50. So I'm talking about that. So you don't do that. You save 1.25%. And let's go to venture debt, right? 16% rate of interest, and they take 15% warrants on $50. You pay 16%, so you pay back 50. You pay $2 every quarter as rate of interest. It's quarterly coupons, and then you pay back the 50 at the end. So you pay $58 back for the 16% ROI. In addition, they take 15% worth warrants. So 15% of 50, which is $8 worth warrants, right? Which you see in this example, which we are talking about roughly 0.2% of equity dilution. And at the end of the year, that 0.2 based on your revenue growth that we have is valued at $10, $11 roughly, right? So effectively you got 50 back and you are paying $69 back if you combine both of these, right? Which is a $19 cost versus in recurring revenue financing, you're paying $5 cost, predictable $5 cost. See the difference for yourself, right? Extremely high. You think it's 16% ROI, that's great. But if you put it down on paper, right, at all points in time, you realize what is it that you're giving, right? Effective. It's a very high cost if you include cost of warrants for a growth company. So I think these are the 4 options primarily available today. Equity is becoming more and more selective. You should, as a founder, always be very prudent about when to take equity. I think pre-revenue, as we spoke about, installation period is the right time to take equity. Going forward for your future growth, try and see how much capital you can get from alternative financing platforms, and if you need even more capital to grow a new business, to grow a new product where you don't know what the payback is, what the end result is going to be. If you're doing a lot of R&D activities, maybe, then it makes sense to get some equity in the mix as well, right? But be very cognizant, guys, that you're losing, heart of your company. You're losing, shareholding of a company. So be very, 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 very prudent about that, I would say. Thanks. I think this is what I wanted to share. I don't know if you're on time. I think we're almost there. So I'll open up for questions. Anything that you guys want to ask, want me to repeat, want me to explain a little further, happy to do that. Any specific use cases that someone wants to discuss, or if they are facing it live, they can discuss it here or separately. Happy to do that.
Yeah.
Thank you.
Eklavya, I'll be moderating the questions for you. I have a few of them on the chat window. So the first one is from Alan, and his question is, ours is a social media platform, Speak app, and has 100K users as of now. So our revenue starts after few years of growth. What are the best options for us?
Got it. No, that's great. Commendable progress, by the way, right? Like 100K users is phenomenal. I think at this stage, given that you don't generate revenue, right, out of business, so revenue-based financing, recurring revenue financing goes out of picture. So I would suggest, you should stick to equity, because you will not get any options, right? Like people may fool you around by saying that we can get you something, but to be honest, till that time you start generating revenue, you will have to depend on equity for your growth, right? This is your installation period in that example that we were talking about.
Okay, so somebody is asking how they can connect with you. Okay, Prashant Nagraj is asking how he can connect with you.
So you can write to me. I can drop you my email on chat, or LinkedIn. I'm accessible at both places, or Twitter, or you can write to me on my email. I just dropped it. Yes, I don't know if it went. So yeah.
Yes, yeah, we got it. So Prashant, you can get in touch with Eklavya at this email address. He's dropped on the chat window. Okay. Okay, so now I do not see any further questions, and I will request you all to, so let the questions keep coming. We would want to make the most of it. We have another 15 minutes with us, so let's utilize it. Okay, so Balaji is asking as a question, hi, what about CGMS?
The government scheme that they're talking about, Balaji?
Yes.
So CGMS is a good government facility. I think they give you capital about 50 lakh rupees, but devil lies in the details, right? Like it looks attractive, like a lot of government schemes. It's not bad, it's good. It's promoting a lot of companies to get some capital, right? And you should definitely look if you can get access to it. It's about time. That scheme will take a little bit of time. It will ask you to give certain amounts of, there are some hidden covenants, so read those carefully. If you can get better terms, why not? But it typically takes a little longer to get that right effectively. It doesn't come with collaterals and guarantees. It is a scheme to promote startup growth in India by government. That's a great initiative. They're doing brilliantly well, but read the fine prints. They will ask you to open a bank account with certain bank, because it will eventually flow through a bank, right? That CGMS scheme as well. So a little more cognizant that banks will come up with their own set of restrictions and whatnot at times. So one needs to be very cognizant about that.
So there's a question from Sunita. Please advise the best way to raise funds for a social cause venture. It's a venture to help the differently able community.
So see, I think there are a lot of social impact funds out there doing both equity and venture debt. There are a lot of them wanting to invest heavily, right? Like there are funds that are raising capital specifically to grow their business or invest in those businesses. So, a lot of them, I can connect you to a couple of them as well if you want on the sidelines, and you can speak to them. I think you're doing a great thing. It's a noble cause. I think people will be very happy and attractive to hear that. So please, you should definitely do that. You will find more money flowing into, social causes these days. But at the end of the day, don't think that, you just started a social business, so you'll get money. I think be practical, be truthful to yourself as well, right? Like what you're doing really has a material impact and is solving a real problem. So be very sure of that, before even you start, right? Like forget capital. When you start, you should be very, very, confident about that.
Zykia has a question. If you do financing, if you finance only the startup companies or any other types of firms, for example, proprietorship kind of firms?
So at Recker Club, we typically finance private limited and LLP companies, but opportunistically we also look at proprietorship companies with an endeavor to eventually moving to private limited and to LLPs. But we can have a look at proprietary companies if it fits, if it has recurring revenue and other things that are the gating criteria that I spoke about in the presentation. So if that is fulfilled, we can definitely look at them as well.
Okay, so Balaji is asking if you have any consultants to prepare the paperwork.
What kind of capital? Because say if it's equity, it is obviously for equity there's just too much happening, and I can connect you to lawyers if you are raising equity. There are some advisors, lawyers that I have worked with, we work with at Recker Club, etc. as well. But when we talk about alternative financing, there is nothing as elaborate documentation, right? That's the beauty of these alternative platforms, where we simply enable people to integrate with their tech stacks and they get the financing limit. There's a couple of digital documents that need to be signed that are also very straightforward. We don't want to complicate life for founders, right? Like I think that's the biggest problem. Investors have been, or lenders have been running with a very different mindset, so I think we are here to enable founders to have that ease of raising capital. I think that's very important. But for equity, if you want, we can speak separately and we can get you in touch with a couple of preferred legal advisors or tax advisors, depending on the stage and the type of the company. And one important thing, if someone is looking for, right, like just don't go by the names of the legal or the tax advisors, right? Like, oh, it's a big name, it will be great. Understand who the person there is actually operating, who the partner there working is, right? Because these are very individual driven projects, right? Effectively, and you want the right advice, and you don't want to pay a huge amount of capital, to them as fees. So be very practical about it as well.
Prashant is asking RBF and RRF. What's the difference in both cases? The cost to company remains the same, however I pay back.
Sure. Yeah. So I'll go back to the example, right? Like I think RBF is a revenue-based financing product, which the 2-3 major differences. I think one is, and revenue-based financing funds you only for your marketing cost, while a recurring revenue financing products finances your predictable, repeatable revenues. And the end use can be for marketing, sales, customer acquisition, software implementation, hiring. So multiple broader use cases. I think B, in terms of the repayments that you are asking, right? If I go back to that example specifically, Supriya, can you share that screen? Maybe I'll use that as an example again, if you don't mind. Say if you are a fast growing company, today your quarterly revenue is 100. Tomorrow your quarterly revenue is 110. And RBF says, I paid you 50. I will take back 55. But you will have to pay me 15% of your quarterly revenue till you pay me 55. Now imagine today your quarterly revenue is 100. You get a couple of new customers. Next quarter, your revenue grows to 200. Let's take an extreme example, right? So you will pay them in the first quarter 15% of 100, which is $15. In the second quarter, you will pay them 15% of 200, which is $30. Right? So in 2 quarters, you have paid them $45, and say in the 7th month, you will end up paying them 55. So in a revenue-based financing product, if you're a fast-growing company, you have paid 55 only, but you have paid that in 7 months instead of the 12 months where you had to pay that, right? So your cost of capital has actually gone up, significantly, because the $10 that you were paying, or the 10% that you're paying in 12 months, that you're paying in 7 months now, effectively, right?
So which slide would you want me to?
Yeah, this slide only.
Yeah.
So Here, if you'll see in the first example, right, we have quarterly revenues of a company, 100, 110, 125, 140. So first use case, the RBF that you see, because you are paying 15% of top line or your 15% of your revenue, which are growing, you pay back $15 in quarter one, 16.5 in quarter two, 18.8 in quarter three, versus a recurring revenue financing. While optically, from a company point of view, you get 50, you pay back 55, but you exactly know how much to pay because you have finance cash flows of your customers for the next 12 months. So you're paying 13.8, 13.8, 13.8, 13.8, right? It's well distributed across the year, right? And in the extreme example that I was saying, so it is not penalizing you for your growth. It is actually we actually reward you for your growth. If you grow, your limit would increase from 50 to maybe 100. In an RBF, if you grow, you will end up paying very, very quickly, right? In the example that I was taking, the $100 to $200, you have paid the $5 additional in 7 months. So if you annualize that, you're actually paying 5 into 12 by 7, right? Which is too much, which is almost $9 and $10. So it's a pretty high number. Yeah.
So can I stop sharing the screen, Eklavya,
Yeah.
and go back to the questions?
Yeah.
Okay, so okay, there are a couple of questions. Okay, Prashant is asking, what's the best way to raise capital for SaaS companies, say, who are in mid-stage?
I think for SaaS companies, solution that Recker has brought in, is phenomenal. Depends on the quantum and the end use of capital. I think there is no one right solution, for raising capital. You need to understand if you are starting a new product line, and every business would have at one point in time, they would be wanting to launch a new product, launching to go to a new geography. For that kind of capital, use equity. But for your business as usual, for your sales and marketing expense, for your customer acquisition, for your service cost, where you will use this and you will start generating more revenue, right? Which will lead to your growth. Definitely try, options like Recker Club. I think founders today, personally, not being biased, right? I come from an investment background. I think founders are lucky today to have these options. Leverage them, for your growth as much as you can, right? Effectively, but simultaneously understand, what you get and what you give, right? Expectations should be aligned. So if you do $100 of annual recurring revenue, right, you can only get $50 from platforms like ours, right? But if you need $100 or $150 of capital, use equity plus alternative platforms together so that they perfectly complement each other.
Okay, so Balaji has another question. What aspects should be taken care of when we take money from friends and family?
And this is an interesting one, right? Like, I think, see, that's trust money, right? They are trusting you, they are giving you money, most of the friends, family, but be fair to them, I would say, right? Like, just because they're giving money, don't think it's free money. I think that's very, very important. Every penny that you put in your business, right? Like, it should give you maximum ROI, and especially when it comes from friends and families. So be at market terms, you can do mix of equity and some convertible debts to them. That's another option that you can do with friends and family. Don't complicate stuff, and don't over leverage through friends and family, I would say, right? Like, it's very easy to get, because they are not assessing your business. They're just trusting you, which is great, right? Like, you need people who believe and trust in you when you start a company, but, give them market terms, guys. Don't try and, snatch something from there. At the end of the day, in fact, you should give them some preferential terms, because they're just trusting you and not going into details of your business.
Okay, so here is the last question from Romit. Do you finance with intellectual property as collateral?
So we at Recker Club, assess the strength of the businesses. If it's only IP, we will not be able to do it, because we are financing recurring revenue, right? So you need to have predictable revenue for you to finance. There are some convertible debt options that one could get if by keeping in IPs as collateral, but it's very difficult to ascertain true value of an IP, right? It has to be established that, that it's free of any charges, it has a certain value, etc. So it becomes very subjective, right? So you have to be an expert if you want to raise capital to that manner. Very few companies or investors do that, but primarily at that stage, I would suggest equity or convertible debt is a better option. If I'm assuming they don't have revenue right now and they're only wanting to raise with IPS collateral.
Okay, so I do not see any more questions on the chat window, and we have another 5 minutes left. So, Eklavya, let's give some time to them if anybody has any questions.
Sure, absolutely. No, and I think what I was mentioning, as founders, just focus on your business, just have your act together by how to grow that business. Don't get intimidated by the type of capital, but so much now noise that someone has raised $50 million, someone has raised $100 million. Don't get distracted by those things. Focus on what you're doing, what you're building, what problem you're solving. Capital will follow, different types of capital will follow. But be pragmatic about, by not diluting, too much to everyone. I think that's very, very important. That don't dilute too much of equity. It's the most expensive form of capital. So be very, very practical about it. Choose wisely your options. And I think that's it. Nothing else to say. We'll wait if there are any questions or we can end.
Yeah, so there are another 2 questions which have come. If we haven't started generating revenue already, how can Recur help us?
Absolutely. So I think while we provide financing, I think that's an important point we should talk about. We work in multiple different other ways as well. We give you something called data-driven insights that you can come to our platform, and we can tell you, your business metrics and other things that are going on, and also help you as a financial advisor. Our team is an expert on that front to get you to the right equity partner, maybe to get you to the right hiring partners. Maybe, we have a bunch of partners, a lot of multiple value adds that we provide as a platform other than just recurring revenue financing. So, if you don't have recurring revenue, we'll not be able to provide you that capital, but all other benefits, we can open it up for you once you get onboarded as on our platform.
Thank you, Eklavya. So we'll take the last question. Okay, I think Limra has already answered that. I think with that, I would like to thank you, Eklavya, for an enriching session today. And I'm sure our attendees, our startups have lots to take away from today's session, as you spoke about the multiple financing options, the pros and cons associated, and the eligibility criteria and which one to opt for. So that was really enriching. Our startups have got enlightened for sure. With that, we come to the close of the session, and we will come back to you with more engaging, more interactive sessions, shortly. I have left the survey form in the chat window here, attendees. Please feel free to provide your feedback on today's session. And thanks a lot to all of you for taking out time and tuning into this session. We appreciate your presence today.
Thanks, Supriya. Thanks. Glad to be here. Thank you. Have a great day, guys.
Thank you. Yeah. Bye-bye, everyone.